So you say emotional and financial fortitude quite a bit. What do you mean by that, and how does that affect asset allocation?
Well, um, financial fortitude essentially is, what is your financial IQ as well as your financial capacity, right?
Mm-hmm.
Because you can have a lot of money, but also have a low financial IQ. And a situation like that might be, let's just say that you've never had any money and you've never really, money's never been a part of your life. You've never been a good saver or anything like that. But all of a sudden you get a big inheritance and you've got $1 million. You might not have a very high FIQ, right? FQ. So you got to think about, okay, what actually is and like, do you understand things like, capital allocation ratios, yields, cash on cash rate? Like, what's your understanding of the financial side of the transaction? Or is it just like, all right, buy houses, right? So it's really about assessing, financial understanding, financial fitness. Like, have you got a track record of being able to manage money properly, all that kind of stuff. That's kind of the financial fortitude side of things. It's not
Yep.
just about money; it's about your understanding of money as well. That's a big one.
Cool.
And then you got emotional fortitude. Right? So some people are more resilient than others. Some people have a higher risk tolerance than others. Some people like things when they're fast and fast paced, and other people like things when they're slow and easy. So if someone has a low tolerance for risk, doesn't want a lot of complexity, maybe has never gone on the journey before, is a little bit anxious about what's involved in property and how much, and oh my God, how does all this work and how do property managers work? And, if there's a degree of stress involved, I would say that's a low emotional fortitude, right? And that's okay because everyone starts somewhere, right? And then that's all good, right? So someone who has got a degree of stress around the process, I would say it's much more important to focus on assets which are not going to exacerbate that stress, right? Because you may buy a great property, but if you get to the other end of it and you've had this, damaging, challenging, stressful experience where you're emotionally scarred because it was all too fast, too quick, too complex, too hard, the likelihood is you're not going to buy any more properties. Well, certainly not for a long time. And then that's actually going to move you further away from your goal, not closer to it.
Mm-hmm.
And so, just in the same way that, I might have a goal to run a marathon, but if I try and run a marathon, if I just go, great, all right, I've decided I'm going to run a marathon and then go and try and run 40, whatever Ks it is, I'm more likely to cause myself an injury. And also, even if I did manage to complete it, I'm going to be in pain and I'm going to be hurting and I'm going to be like, screw this, I'm never running again. Running sucks. This is the worst thing I've ever done. Versus if I said, okay, cool, I would like to be able to run a marathon in 12 months. So what I'm going to do today is I'm going to start by running 1 kilometer, right? And then slowly building up to that, I would probably find that I have more enjoyment, more sense of achievement, and more sense of fulfillment along the way. And I think that this is the way to think about it. It's not about just going, how fast can I get into the highest ROI deal? It's about going, okay, what is actually going to satisfy me along the way? Because all of this is about the journey. The goal is cool, right? But the goal is not going to happen really, really fast. None of this is get rich quick kind of stuff. And so if you take let's say a 10-year time horizon with the whole thing, this is going to have to be something that you're going to enjoy. And you've got to think about that, not just about money as well. Does that kind of make sense?
It does, and I think it's way more important than people give it credit. Like the role of emotions in property in this whole kind of world, because it really starts with self-awareness, right? It starts with like taking stock of not just literally like asset wise, where are you at, and resources, but where am I at in terms of like the realm of my life and what else do I have going on, and being really honest and clear with yourself about what I can take on right now. So if we go back to that example of someone who's got, maybe a lot of equity, but not a lot of income, and they're kind of thinking that I'll go and do some kind of chunk deal, or they might do might try to do a full renovation interstate, like they'll do it borderlessly and not go there and try and manage that on top of their whole life, what is currently happening. And so we actually see this happen to people where they will take that on as their first investment kind of their first step into property investing, and that's the first thing that they try to do, because again, it's a good strategy and works for some people, but they're not thinking about how it fits into their whole life. And so they go through that experience, and it is so stressful. It is so damaging just from the added stress that you end up leaving that experience. You might have a financial reward off the back of it when you actually finally finish it, but you are emotionally scarred from that experience, and you automatically make the assumption, well, this isn't for me. And you jump to property investing is really hard because you've accidentally done the wrong strategy for where you're at emotionally at that point in time.
Totally. It's kind of like dieting, right? Like if someone wants to go on a diet and, let's say they're like, hey, I'm too fat and I want to go on a diet. And then they go to an extreme and they go, I can only eat grapefruits. And they might lose a whole bunch of weight really, really fast. But it's not, it's not going to be something they're going to be able to stick with, and they're going to bounce back and they're going to get back to where they were. Right. Yeah. And so it's about going, okay, what's going to be sustainable? Like what's the sustainability context with this whole thing, right? It's a marathon, not a sprint, right? Yep. And to that degree, there's this really interesting dichotomy though. It's like, it's cool for it to take some time. So let's don't get too caught up in, should this be a 6% yield or a 6.2% yield? Like, given the time horizon, it doesn't really matter. Like, as long as you don't run out of debt and capital, and as long as you're managing your capital to debt ratios along the way, and your debt to income ratios along the way, you're all good. Like, you just keep on motoring, you just keep on humming. Which is in fact why we have such a high volume of clients that are buying 3 to 5 properties a year, because we pay really close attention to, okay, like what's the availability of debt and how we're going to manage that, right? So you can it's all good. Just focus on those things and you'll keep ticking through.